Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance. And let me tell you, this latest filing from FTAI Infrastructure Incorporated is quite the ride, especially with that massive acquisition and some interesting debt maneuvers. We are diving deep into their third quarter report, and trust me, there are some eye-popping numbers and crucial strategies we need to unpack. If you are new here, make sure to hit that subscribe button so you don't miss out on any of our corporate deep dives. And hey, join our Discord community linked in the description below for even more exclusive content and discussions. Let's get straight into the core financials. Looking at the balance sheet as of the 30th of September 2025, the company reports total assets of a whopping $5.45 billion compared to nearly $2.4 billion at the end of 2024. That is a huge leap, and it tells us something big has happened. A major driver of this asset growth is property, plant, and equipment, which jumped from $1.65 billion at the end of 2024 to a massive $3.25 billion. This signals significant investment in physical infrastructure. And then there is this line item, a $1.11 billion investment in the Wheeling Corporation as of the 30th of September 2025 compared to zero at the end of 2024. This is clearly a major acquisition that is shaping the company's balance sheet. Unsurprisingly, with this growth, liabilities also surged from $1.91 billion to over $4.37 billion. This tells us they are using a lot more debt to fund this expansion. Now, we see a new entry here for redeemable preferred stock series, a Railco non-controlling interest at $906 million. This points to complexities with how they structured the financing for some of these acquisitions, bringing in outside capital with specific redemption rights. As a result, total equity actually decreased from $75 million to just $20 million. Indicating that the debt and preferred stock financing has far outpaced any increase in equity. Moving on to the income statement, we see total revenues jump from $83 million in the third quarter of 2024 to $140 million in the same period of 2025. That is a solid 68% increase, showing the impact of their new acquisitions. Specifically, power revenues went from zero to over $56 million in just one quarter, a direct result of bringing the Long Ridge Energy facility fully on board. However, this revenue growth came with significantly higher expenses and other costs. The company reported a loss before income taxes of $99 million for the third quarter of 2025, a big jump from a $43 million loss in the same period last year. Ultimately, this translated to a net loss attributable to common stockholders of $159 million compared to just $50 million in the prior year. It is clear the growth comes at a significant cost, at least in the short term. Looking at cash flows, this is where we see the true strain. Cash used in operating activities ballooned from about $7 million for the first 9 months of 2024 to a staggering $115 million cash burn in the same period of 2025. This is a major red flag, indicating the business operations themselves are not generating enough cash to cover expenses. Investing activities show a massive increase in cash used, from $90 million in 2024 to over $1 billion in 2025. This is driven by those big acquisitions we saw on the balance sheet. To cover this, financing activities provided over $1.4 billion in cash in 2025, up from $154 million. This is clearly how they are funding their aggressive growth, primarily through taking on more debt. And speaking of debt, the debt on their balance sheet exploded from $1.91 billion at the end of 2024 to over $3.7 billion by September 2025. This is a huge increase in leverage. Even more concerning, the principal debt due within 1 year jumped from $48 million to over $1.5 billion. This means a massive chunk of their debt is coming due very soon. The company is also heavily reliant on its manager, FIG Incorporated, with management fees and incentive allocations being a significant cost. Now let's talk about risks. The filing highlights a laundry list of concerns, including their ability to operate as a standalone company, economic uncertainties, customer defaults, and intense competition. The sheer length of this risk factors section is a bit daunting. On the balance sheet, we see a significant increase in restricted cash from $119 million to over $319 million. This cash is set aside for specific purposes, likely related to their debt agreements and project funding, which is good to know it is there, but also means it is not readily available for general use. The increase in total revenues to $140 million for the quarter is undeniable, fueled heavily by new power and gas operations. But those operating expenses are also up significantly, especially in the power and gas segment due to that Long Ridge acquisition. And the other expenses, particularly interest and losses from debt modification, are also ballooning, eating into any revenue gains. In the railroad segment, revenues dipped slightly, but expenses climbed, leading to a lower net income income for the comparable periods. This is a mature business, and it seems to be facing some cost pressures. The Jefferson Terminal segment showed revenue growth but higher interest expenses, and some debt modifications led to a net loss for the quarter. The power and gas segment, buoyed by the Long Ridge acquisition, is now a major revenue driver, but also a major expense center, contributing significantly to the company's overall loss before taxes. The sustainability and energy transition segment appears to be more of an investment play with minimal current revenue, but significant equity losses from unconsolidated entities. Corporate and other, a catch-all category, is showing a massive increase in expenses, largely driven by interest expense and losses from debt modification or extinguishment. This is where a lot of the financial engineering and holding costs reside. Now, the company emphasizes adjusted EBITDA, a non-GAAP measure. It paints a rosier picture, showing an increase in adjusted EBITDA to $70 million for the quarter. However, it is crucial to remember how they arrive at this number. They add back many of their biggest expenses like interest, depreciation, and losses on debt modifications, while also excluding equity and earnings from other companies. It is a common corporate tactic to present a more favorable operational view, but it is vital to look at the GAAP numbers too. When looking at liquidity, the company admits its current cash and forecasted cash flows are not enough to cover $1.55 billion in debt due in the next year. They are banking on refinancing efforts, the Wheeling acquisition, and other plans to fix this. This is a serious liquidity warning sign. Their debt obligations alone are $3.8 billion, with $1.6 billion due within the next year. This is a huge amount for a company of this size and growth phase. Now, looking at these numbers more broadly, FTAI Infrastructure Incorporated is making a bold, aggressive play for growth, evidenced by those massive acquisitions and the jump in assets. However, this expansion is heavily financed by debt, leading to a significant increase in their debt burden and a concerning near-term maturity wall. Their operating cash flow is deeply negative, meaning the core business is not yet profitable enough to sustain the operations and pay the bills without constant reliance on the financing markets. The company is painting a picture of future success through these investments, but the immediate financial reality is a lot of red ink on that income statement and a very tight liquidity situation. They are clearly betting big on the future success of these new ventures and their ability to refinance their massive debt load. The next year will be absolutely critical to see if their strategy pays off or if they run into serious trouble. Alright, that is our breakdown of FTAI Infrastructure Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.